Investor matchmaking is a very important stage, and it's crucial because this is the point where you start having conversations with investors. You have figured out that you're eligible and prepared and ready for capital raising. You have prepared and have the requisite material, and now you need to talk to the right investors. The typical process will involve identifying the capital needs. How much are you raising, for what, in what period of time? Preparing the right documentation, the teasers, the pitch deck, the financial models, and ensuring your audit is well done. Identifying the right investors. It's very critical to identify the right investors. Most of the time when businesses say they are struggling talking to investors, or they've talked to X number of investors and have not been successful, it's because they are talking to the wrong investor. It is very important to talk to the right investor, and also to be prepared and be able to do the right pitching and investor meetings. When successful, then you should be expecting to get letters of intent and term sheets before you move into the due diligence and binding of a process. Typical myths is that when you receive a non-binding term sheet, then an investor will surely invest. That is not true, because that is a non-binding term sheet, and in some cases it can even be binding, but you'll still not be able to have the investment closed for one reason or the other.
Why this due diligence is critical? It's really the due diligence provides you an assessment of the company's financial health, okay? So that you are aware of what are the company's assets, liabilities, what are the risks involved within the business, and also, are there any red flags that one needs to look into when buying that company? Now, remember, when you're negotiating a deal, you don't have all the information about the company. You've looked at the financial statements and you looked at other high-level information to agree on that deal. But at that stage, you don't know the intricacies of the business, and the financial operating and tax due diligence helps you to get into those. And most of the time, a financial DD is done when you're having a merger or an acquisition, or you're looking at an investment evaluation. This is sometimes what doesn't happen. A lot of people do a finance DD on mergers and acquisition, but when it's an investment evaluation, you look at the documents that are provided, but sometimes don't go into the depth of the financial condition of the business. So it's very critical to do that. So what is, why is it important, in capital raising? Because it provides you, as I say, the comprehensive understanding of the company's financial situation before you actually commit the funds. And part of the financial due diligence is the issue of the quality of earnings and cash flow, because as people say, revenue is vanity, profit is sanity, but cash flow is reality. Okay? And so, this gives you a much better understanding, on the
tax due diligence is also something that is very important for buyers to perform during an M&A transaction for a number of reasons, but the most important being the one to be able to identify any possible tax deal breakers. Now, every business owner knows that they are required to pay income tax. However, this is only the tip of the iceberg in terms of potential tax obligations. And as Ashif has mentioned just now, that there are several obligations that are, tax obligations which need to be complied. And we often find that in transactions where a lot of them go amiss or people are not compliant, and you can imagine you're inheriting a company with such potential tax liabilities. So obviously a thorough investigation of the target company's tax obligation and tax implications of the deal itself are critical to a profitable transaction.